When global financial markets shake, retail investors look at stock charts. But you want to look at the invisible engine underneath. What is driving these moves? Given recent events, I felt the need to hold a special lesson tonight, and I'm happy to have Ms. Volpe here to start us off.
Grazie, Headmaster. Welcome to the world's most lucrative illusion, the yen carry trade. Imagine a central bank that keeps domestic interest rates pinned near zero for decades. To an institutional investor, that isn't just central bank policy, it's free money. You borrow billions in Japanese yen at a fraction of a percent, convert those yen into US dollars, and park that capital in high-yielding assets abroad. You harvest the spread while the exchange rate remains stable. It operates as an invisible siphon until the Bank of Japan shifts rates or currency volatility spikes, turning cheap leverage into an instantaneous liquidity crunch. And that's exactly what happened on July 31st, 2024, when the Bank of Japan raised rates to 0.25% and signaled further hikes, shattering the illusion.
And that tiny quarter-point hike triggered a catastrophic domino effect.
As the yen suddenly, rapidly appreciated, the carry trade inverted overnight. Every leveraged position became an active loss. Traders faced instant margin calls. To cover their original yen debt, institutional investors didn't just exit currencies, they were forced to liquidate their winning global assets all at once.
On August 5, 2024, Japan's worst single-day market crash since Black Monday 1987. The Nikkei plummeted 12%. Tech stocks lost over $1 trillion in value in days. Trillions of dollars in global liquidity vanished in 48 hours because the world's cheapest funding currency suddenly demanded to be paid back.
Even after this, the underlying forces of mathematics and desire for higher yield won again. Because US interest rates remained significantly higher than Japanese yields, global investors gradually rebuilt yen-funded carry trades, borrowing cheap yen to chase higher yields overseas. By mid-2026, capital outflows pushed the yen to a 40-year low. This sets the stage for recent events.
Thank you, Vitoria. Now let's head to Professor Herd's classroom, as this doesn't just impact the yen, but will have larger global ramifications. Couldn't help myself.
Alexander.
And when a currency depreciates too far, defending it creates a seismic shockwave across global bond markets. Why is that, Ignatius?
Because money doesn't materialize out of thin air. When Japan's Ministry of Finance steps in to defend the yen, they need massive cash reserves in foreign currency. And where is that capital stored? Short-term cash reserves, yes, but ultimately, U.S. Treasuries. As Japan is the largest foreign holder of U.S. national debt, defending the yen unilaterally would force Tokyo to sell massive quantities of U.S. Treasuries to raise dollars. To buy yen, central authorities must dump U.S. Treasuries into the open market. When a top foreign sovereign holder liquidates billions in bonds, prices plummet and yields surge. This is how action taken in Tokyo instantly drives up long-term domestic borrowing rates across the globe.
To curb currency instability and protect the bond market, the U.S. Treasury executed its first joint intervention with Japan in 15 years. The U.S. purchased an estimated 5 to 10 billion in yen, alongside tens of billions deployed by Tokyo. Authorities step in with direct market interventions, not merely to fix an exchange rate ticker, but to prevent long-term sovereign bond yields from spiraling out of control. Forex drives debt, debt drives yields, and yields drive global capital. Understand the machinery, or get crushed inside its gears. Here's tonight's summary.
unwinding the carry trade forces over-leveraged funds to liquidate assets simultaneously to cover their original yen debt.
While central bank interventions flood the market with dumped debt securities to supply the cash.
This special class is dismissed. Be sure to check for new lessons when they are available. Our faculty teach on a part-time basis, so you never know who will be in when. As always, don't hesitate to reach out to me for assistance, or if anyone is giving you a hard time. Rest well till next time.